Welcome back to the channel, everybody. My name's Artie with CoinCasso, and in this episode, we go over the top news articles written in the last 24 hours so that you guys can stay up to date and informed on everything going around in the cryptocurrency world. Let's not waste anybody's time, jump right into this first article, which is titled, Black Thursday's Distortion Makes Bitcoin Options Look Cheaper. With a key metric declining to record lows, Bitcoin's options market may be underpricing cryptocurrency's future volatility. Analysts say the data is being used to distort by Black Thursday's 40% drop. The spread between Bitcoin's 3-month implied volatility and historical and realized volatility fell to negative 47% on Wednesday, the lowest since the crypto derivatives research from Skew began tracking the data 18 months ago. Implied volatility is the market's expectation of how risky or volatile an asset will be in the future. It is computed by taking an option and an underlying asset price along with other inputs such as time to expiration. Realized or historical volatility is the standard deviation from the average price of the underlying asset. It measures volatility actually realized in the past. A lot of this article is technical analysis, so if you understand these terms, please go read this article because it's very interesting how this company Skew is actually tracking Bitcoin and using the technical indicators that you would use in the US stock market to see how Bitcoin's going to do in the future. The issue is that Bitcoin and cryptocurrencies are so up and down constantly that it's a really hard determining factor to see 7-day, 10-day, and 50-day moving averages actually predicting the price correctly. Plus, they're taking into consideration the entire market drop in the beginning of March due to the coronavirus, which is making all the statistics messed up, which is why they're saying it's making Bitcoin options look cheaper. And onto our next article of the day, which is titled Bitcoin Breaches 9.2 thousand as open positions on CME futures hit a 10-month high. Bitcoin is quickly gathering upwards momentum alongside the surge in open positions on futures listed on the Chicago Mercantile Exchange. The top cryptocurrency by market value jumped to a high of 9,220 at 10 o'clock on Wednesday, having settled above 9,000 on Tuesday to register its first above 9,000 daily close in 2 months. Meanwhile, open interest, or the number of futures contracts outstanding on the CME, rose to 351 million on Tuesday, the highest level since July 10th, 2019. Simply put, the uptick in the CME open interest does not necessarily represent institutional activity, more so as the exchange accounts for a small portion of the global futures open interest. The total open interest in futures listed on major exchanges across the globe stood at over 2.5 billion on Tuesday, the highest level since March 11th. When the tally was around 3.8 billion. Meanwhile, CME's contribution to the global tally was only 14%. The cryptocurrency has broken out of its 6-day long narrowing price range, signaling a continuation of the price rally from lows near 6,700. The move strengthens the case for the rise to 10,000 ahead of Tuesday's mining reward halving. Basically, what this article is saying is that the future price of Bitcoin, what people are predicting the price will be, is at an all-time high. Because we've shot up and down, but it's been narrowing, and it finally broke out of that narrowing pattern and is starting to go up. So we should see this 10K mark be hit quite soon. And onto our last article of the day, which is titled, Derivatives May Reduce Miner Selling Pressure After the Bitcoin Halving. With less than a week to go before the expected May 12th halving event, Bitcoin's price is swinging upwards. The crypto derivatives market is helping to hedge the uncertainty on which way the Bitcoin market will go when miners have less revenue after the halving. While in theory, a decreasing supply and stock to flow models may suggest a surge in price, the reality is a lot more complicated. A far larger, broader spot and derivatives market means that miners selling is simply less impactful. With this upcoming halving, there are so many moving parts in play. There's more people getting into cryptocurrency using their stimulus checks. A lot of the movement in the cryptocurrency market is due to miners selling what they've made from mining blocks. After the halving, the amount of Bitcoins injected into the market is reduced by 50%. So we're going to have less available Bitcoins, more people buying it, less people mining because it's less profitable for them. All of these things mixed into a pot is going to determine the price of Bitcoin after the halving. And again, I don't have a crystal ball, so we're just going to have to wait and see what happens. I hope you guys enjoyed this video. I hope you got some value out of it. Please don't forget to like the Facebook page, subscribe to the YouTube channel, and join us tomorrow when we go over the top cryptocurrency prices as well as the news, just like we did today. Thanks for watching, and we'll see you tomorrow.